Welcome to the all-star ratio analysis. In this video we are going to do the ratio analysis for all-star, and we're going to do it in a what you might call a stop-start process. So I recognize that up until now along the journey is we've completed the income statements and the balance sheets and the cash flow statement. We haven't done any ratio calculations yet. So I'm going to suggest that you watch this video while doing the all-star ratio calculations. And that's going to be the last point on this slide, which is to measure the performance of all-star using ratio analysis. In the last video, I took you through the calculations of profitability, looking specifically at these three profitability ratios. What I'm going to suggest you do now is pause the video and go and do the calculations for all-star in the final grid that's provided as part of the case study, and calculate these ratios for both years. And once you've done that, then come back to this video and then keep going, and you'll see what follows next is the answers to those calculations and a discussion about what they mean. I hope these numbers look familiar. So let's start off with the gross profit from the 2017 year, which was 20%, and that is the same as what was given to us in the case study. In 2018, this gross profit has increased by 8.3% to 28.3%, and the reason for this higher profit margin is what this is telling us. The reason for this is we have introduced new products into the business, specifically the mattresses that are being produced by the new manufacturing plant. And because of the introduction of these new products at a higher profit margin, the overall profitability of the business has increased from 20 to 28.3%. This increase in profitability can also be seen at the operating profit level. Now, the only difference between the gross profit and the operating profit, if I go back one slide, is that there is an expense line in there. So the introduction of that expense line will make the operating profit lower, but if there's higher profit margins at the GP level, these often translate to the operating profit level. And that's the case here. And in addition to this, you can see that the difference between 2017 and 2018 has increased from the previous level. So we've got higher profit margins, and therefore we must have reduced expense percentages, and those percentages are measured as a percentage of sales. So I've done those calculations. You might have also done them if you were prompted to do so in the grid. And just notice here the overall expenses as a percentage of sales. That's just the sum of each line item here. The overall percentage has reduced by 1.5 percentage points, and that's measured as a percentage of sales. And you can see here that the profit margin, the difference between 8.3 and 9.8, has increased by 1.5 percentage points. So that makes sense. Specifically, what's happened is the selling costs have been reduced. That's the major contributor towards those efficiencies. The last of the profit margins is the earnings after tax, and here you see the 3.1% became 7.7%. That's great because that's an increase, but this increase is only 4.6%, which suggests we have lost out on some of the gains. And the reason for this is now when we get down to the bottom of the income statement, we have now taken particularly the interest costs into account. So that's the major reason why this profitability growth has declined, because in 2017 there were no interest charges. All right, so there's a quick overview of the profitability. In the case of all-star, the profit margins have increased at every single level through the income statement, and that is a very good result. The next area of ratios that we're going to look at are the activity ratios. And here we looked at the amount of sales that are generated by using these different categories of assets in the balance sheet. So perhaps stop the video now, go back to the ratio sheet if you haven't completed all the ratios, and do these calculations, and then we'll come back and analyze the results. Here we have the activity ratios, starting off with the net asset turnover rate, which is typically what I loosely refer to as the activity rate in the business. And we discussed the fact that we want this number to be as high as possible. So what we see here is from 2017 to 2018 is a decline in this ratio. And the major reason for that decline, even though the sales are going up, the reason for the decline is because they have bought a whole lot of new assets, fixed assets, and there's extra working capital assets from one year to the next. So the denominator in the calculation, the denominator, the sales over the net assets denominator, these net assets have gone up by more in proportion to the amount that the sales has increased by. Therefore, we get this lower activity rate. On the surface, that might be seen as a decline in performance. However, in any year in which a business is investing heavily in new assets, it is typical that we would see this decline. We might expect in the following year, 2019 for All-Star, that this ratio would hopefully start to trend back up as they increase their sales without having to invest in new assets. So if we break down the net asset turnover rate, we can measure this as a fixed asset turnover rate, which here is the sales over the fixed assets, and we can measure it as sales over working capital. So when we do that, we see that the fixed asset turnover rate has declined, and that's because of the new production plant. And here we see that the working capital turnover rate has declined. And specifically, we need to go and find out why is that. And the reasons are quite clear when you look at the following ratios. So let's start with the inventory days. This tells me we had inventory on the shelf for 9 days in 2017, but by the time 2018 rolled around, inventory is on the shelf for 18 days on average. So that tells me there's more stock in the business. We have a production business now. So we've got raw materials, we've got work in progress, we've got finished products, whereas in the previous year we simply had an agency business where we bought and sold from a supplier, and most of that stock was on consignment, so it wasn't even on our balance sheet. So what we're seeing here is the introduction of this production business. That being said, these inventory days are still quite low. However, this is having an impact on the performance. The debtor days, I hope you recognize the number of 44, because that was given in the story as part of the first year 2017 brief. And what's happened by the second year is we realize that our customers are taking longer to pay us. And that's primarily because of the contract with the NGO to supply mattresses. They take longer to pay. But this is affecting the cash flow of All-Star. Remember the working capital rules that we spoke about in the cash flow theory? If your debtors, or in this case the debtor days, goes up, your cash flow goes down. Hence my comment here, this is bad for cash flow. With regard to our suppliers, the creditors, we were paying them on 27 days, and we're now paying them on almost 20 days. So we are paying our suppliers sooner. For whatever reason, they're doing that. Not sure, it's not very clear. Maybe their suppliers are tightening up their arrangements, or the shareholders thought there was more profit so that they would just pay sooner. Who knows? Whatever the case, this is bad for cash flow, paying our suppliers sooner. So overall, these activity ratios are not looking great. We were looking good in the profitability, but not so good in the activity ratios. And I'm specifically concerned about the working capital ratios, not so much about the fixed asset ratios. I expect that those will improve by themselves in the coming year. This brings us to the next area, the leverage component. And here we're just looking at the debt in the business. So this is not too complicated. Take a moment to go and calculate those ratios for All-Star, and then come back and check your answers. And here you can see that in the first year, it's clear there's no debt in the business. So the debt to equity, the debt to total capital, the leverage ratios, these all represent no debt in the business. So just notice that leverage is at 1 when there's no debt in the business, but the other two ratios, the percentage ratios, are at 0. And clearly we can see in the following year, the introduction of the R1 million worth of debt has increased these ratios quite substantially. Debt to equity shows this as 90.9%. Debt to total capital is 47.6%. So these are just two different measures of the same thing. And just notice that on the debt to equity ratio, this could be, you could round this up to 91% if you want. Look how similar it is to the leverage represented as 1.91. So it's just showing that there is debt in the business, and I'm going to show you a little bit more information in the next series of videos around how this information is important to understanding the performance of the business. So in this video, we've looked at All-Star in terms of profitability, activity, and leverage. In the next video, we're going to tie those together to really get an understanding as to whether All-Star is a high-performing, healthy business.